Welcome to RSM's Tax Summit Week 2021. Today's session is mergers and acquisitions across North American borders. At this time, I'm pleased to turn our call over to our first presenter, Mitch Siegel. Mitch?
Thank you very much, Liz, and thank you everyone for joining. We greatly appreciate it. At this session, we are going to cover some pressing issues regarding mergers and acquisition activity within the U.S., Canada, and Mexico. I do want to introduce our speakers. I'm Mitch Siegel. I run our cross-border M&A practice. I'm also our operational head for our virtual M&A hub. And we're fortunate to have two members of our virtual hub on this webcast. We have Mauricio Garza, who's a director at RSM Mexico, and Michael Joseph, who's a senior manager in Toronto. For those of you that aren't familiar with our M&A virtual hub, we have a number of professionals from our M&A practices outside of the U.S. that are now virtually assisting with cross-border M&A activity. We hope, beginning of next year, that many of those participants in the hub will actually be coming to New York. Michael, who is a member of our hub but is based in Toronto, will stay in Toronto, but we hope that once we're able to travel freely that we can continue to do that. And I think many of you know that we do run our U.S. tax practice and our M&A practice as a North American practice. So Canada and the U.S. are very much tied at the hip. So wanted to thank Mauricio and Michael for participating in this webinar. And I will start out with an overview of what we're seeing from a U.S. perspective. Then I will shift to Michael, giving a Canadian perspective. And last but not least, we'll have Mauricio finish things off for us. So again, thank you for joining. Okay, so during the session, as I mentioned, you should be able at the end of this issue to articulate some pressing tax issues associated with investing in Canada and Mexico. This session will be primarily focused on U.S. outbound. So U.S. multinationals, U.S. private equity clients investing in Canada and Mexico, and we'll try to give you some of our thoughts regarding what we might see in terms of future legislation, which, as those of you that are joining from the U.S. know, is very challenging to anticipate at this point in time. Okay, so what are we seeing in the U.S. from an outbound perspective for U.S. multinationals, U.S. corporations investing in both Canada and Mexico, and our private equity clients? And we do a lot of work in both spaces, but a significant amount of work in the private equity space. Okay, so where to place debt is extremely important in a deal setting, especially with respect to our private equity clients. And as I think you know, the U.S. has thin capitalization provisions under Section 163J. Those provisions were modified with respect to the Tax Cuts and Jobs Act, the TCJA, which was effective in 2018 during the prior administration. It was a significant change in terms of deductibility of interest. The U.S. has been struggling from a regulatory perspective in terms of being able to give guidance in terms of what is debt, what is equity, and what is deductible. And previously, these 163J provisions only dealt with U.S. inbound clients. But now there's been a change as of 18 in terms of what's deductible in the U.S., and it's formulaic. So the TCJA limits interest expense in the U.S. to 30% of what's defined as adjusted taxable income, 30% of adjusted taxable income. The CARES Act increased that limit to 50% for tax years beginning in 19 or 2020. So now for 2021, we are back to a 30% limit. Adjusted taxable income is effectively EBITDA. But using taxable income instead of book income. So it's taxable income with add backs for depreciation, depletion, and amortization. For years beginning after January 1st, 2022, which, believe it or not, is fast upon us, the limit is going to be based on more of an IBIT type of computation, but using taxable income instead of book income, so it's taxable income before interest. So as you can see, that limit is going to be reduced for taxable years beginning after January 1st, 2022. So what are the implications of this? So from a structuring perspective, what we're continuing to see is that U.S. multinationals, as well as private equity clients and other flow-through clients, are often involved in modeling deductible interest expense before we even get into a due diligence exercise. And in order to, and if the U.S. group is going to be at or exceeding that interest deductibility limit, so that a portion of the interest that's going to be incurred on the deal is not going to be deductible, there is a push to be able to allocate some of that debt to non-U.S. operations. And in order to separately allocate debt to non-U.S. operations, including Mexico and Canada, which is the focus of this webinar, generally requires a separate acquisition of those entities. We often get questions, or sometimes get questions after the fact, once a U.S. group realizes their limit, gee, how can I push down debt to a foreign jurisdiction? And generally the answer, after the fact, and generally the answer is that's not going to be possible unless you're making future investments in those jurisdictions. So the time to allocate debt to a non-U.S. jurisdiction is at the beginning of a deal, and obviously needs to be negotiated with the seller. In many jurisdictions, we are able to acquire non-U.S. entities separately where there's a participation exemption or there are other attributes that can be utilized against gain from separately acquiring non-U.S. entities. But very important to have that worked out up front. And as I mentioned, that structuring and that tax modeling, which includes projected tax deductibility of acquisition debt, is often undertaken at the start of the acquisition process. Okay. So the U.S. has had anti-deferral provisions with respect to non-U.S. entities that are controlled by either a U.S. corporation or a U.S. partnership. Those provisions have been in place since the early 60s and are referred to as our Subpart F provisions. However, those Subpart F provisions are somewhat limited. They relate to passive income earned in a controlled foreign corporation or related party transactions, and there are many exceptions. So the one thing that significantly changed as a result of our last tax reform, the Tax Cuts and Jobs Act, was the imposition of GILTI provisions, global intangible low taxed income provisions, which pull in much more non-U.S. income to be subject to U.S. tax. The good news is, as I mentioned here, there's a high tax exception available where the non-U.S. income is subject to a rate of tax of at least 90% of the U.S. corporate rate. There is currently a reduction of that deemed income inclusion for a 10% return on active business income, actually active business assets. And then there is some availability of foreign tax credits available for U.S. corporations, and also, as I mentioned, a high tax exception to eliminate the residual U.S. tax on GILTI income. Currently, and we're going to talk about what might change, GILTI income is aggregated, so all of the GILTI income for controlled foreign corporations is aggregated, and you can use losses for certain controlled foreign corporations, GILTI losses against other entities that have GILTI income. And a U.S. corporation generally only needs to pick up 50% of GILTI income. The other 50% is subject to a deduction. The exception is where that U.S. corporation is incurring losses, then you generally have an inclusion of 100% of the GILTI income. And the last point on this slide is good news. As many of you may know, there were previously, prior to 2018, provisions that precluded a U.S. corporation from pledging foreign assets or foreign stock as security for a loan. If you did so, you had an income inclusion. However, U.S. corporations are now benefit from a dividends received deduction on active income of a controlled foreign corporation. And that provision generally allows U.S. corporations to be able to pledge either stock or assets without having an income inclusion. Now we'll contrast that with what we see and what occurs with respect to flow-through entities, specifically private equity clients. So private equity clients, the Subpart F or guilty inclusion takes place above the partnership, above the U.S. partnership or the foreign partnership. It only applies to 10% U.S. partners. However, there are some attribution rules that could cause a partner who doesn't directly own 10% to be considered a 10% U.S. partner. The high tax exception does apply at the U.S. partner level to eliminate residual tax on guilty income as well as Subpart F income. U.S. individuals, however, don't benefit from a foreign tax credit. So if that high tax exception isn't made or if it's not elected, a U.S. individual does not receive benefit for foreign taxes paid within the corporation. There is an election that an individual can make to be treated as a corporation, but that's sort of beyond the scope of this discussion. Now, here's a significant difference with respect to private equity funds. If they pledge non-U.S. assets or CFC stock, they will have an income inclusion at the partnership level. A partnership does not qualify for that dividends received deduction. So this is sort of a trap for the unwary. When you're financing through a private equity fund, you need to be cognizant of the provisions in terms of pledging either non-U.S. assets or stock, because there will be a deemed income inclusion, and deemed income inclusion will apply to all of the U.S. partners in the fund. That inclusion, though, can be avoided if no non-U.S. assets are pledged or less than 2/3 of CFC stock is pledged. So, again, need to be careful in terms of what type of security is going to be provided to financial institutions, and again, that needs to be negotiated up front. Okay, I'll conclude with two slides. One on what we might see in terms of changes to U.S. tax law, and the other are some takeaways. So as I think those of you that are joining this call know, there are currently bills in Congress that would would change U.S. tax law and certainly have an impact on the provisions that we're discussing. And we don't have a crystal ball in terms of whether or not those provisions will be enacted, but they need to be understood. You need to take those into account. One provision would have a per-country foreign tax limitation on guilty income, so you would not be able to cross-credit. You wouldn't be able to use high-tax guilty income against low-tax guilty income, which is a reason why many U.S. taxpayers don't elect high-tax exception today. Possible reduction or elimination of that 10% return on qualified business assets, potential loss of ability to offset CFC losses with CFC income, again, going to a per-country limitation, and finally, the guilty rate might increase as the corporate rate is going to increase. Okay, so some takeaways. No one-size-fits-all in terms of structuring. We need to model, we need to think about the implications of each specific deal. Many U.S. multinationals and U.S. funds are really focusing on achieving U.S. benefits because the benefits of having income taxed overseas is diminishing and may be eroded further by potential legislation. Many U.S. multinationals and corporate taxpayers are looking for step-ups in the U.S., and they're focusing on purchasing intangible assets in the U.S. where possible so that we could achieve U.S. amortization deductions. As I mentioned, that the guilty reduction for business assets doesn't relate to intangible assets. It relates to active business assets. So that's a reason why many multinationals and private equity funds look to have the benefit of intangible assets in the U.S. So certainly consider how income overseas could be reduced by shifting functions and risks and possibly conducting non-U.S. entities through check-the-box elections as transparent entities. And as I've mentioned a few times, tax modeling has increased significance. Okay, so hopefully this has given you a good understanding of where we are with respect to anti-deferral and financing from a U.S. perspective. I will now turn it over to Michael Joseph to give us a Canadian perspective.
That's great. Thanks, Mitch, and hi again, everyone. Turning now to Canada. So, even though, we have a very similar, culture and we're very similar to our U.S. neighbors to the south, there are some tips and traps for the unwary that most non-residents of Canada who come into Canada to do a deal should be aware of. And, there's some unique features to the Canadian tax system that, we've tried to identify in the following slides. And by no means is this an exhaustive list, but hopefully it gives a flavor for some of the things that, non-residents of Canada should be aware of when they're seeking to do a deal in Canada. So we'll start off first looking at an asset sale. So typically, as is the case in most other jurisdictions, vendors and purchasers have competing interests when it comes to the benefits associated with acquiring or selling assets. So from a vendor perspective, selling assets in Canada is generally not preferred, and there are a few reasons for that. The first one being that there's two layers of tax. One inside Target Co, we called it here, which can involve things like recaptured depreciation, which is fully taxable at full rates, and capital gains, which are 50% taxable in Canada. And then there's an additional layer of tax on getting the proceeds out to the individual shareholders. And so the upfront tax rates can range anywhere between 25 and 49%, depending on the tax attributes and province of residence and the tax attributes in the target. But in addition to this double layer of tax, and it's a second bullet point that really is the big one from a vendor perspective, and that is when selling assets, an individual cannot claim their lifetime capital gains exemption, which is one of the main features of the Canadian tax system. And effectively, what that is an ability for an individual, a Canadian tax resident, once in their life, to claim approximately $890,000 Canadian exemption from capital gains tax. So it's about a $240,000 cash tax savings if we're, at a rate of approximately 27% personally. So a very, very important and attractive feature of our system that generally makes vendors want to sell shares rather than assets. And so tax really is a principal driver on these transactions when looking at assets versus shares. And clearly there's also other transfer tax and administration costs associated with consents and transferring employees and leases and things of that nature. So that is something that, vendors generally have to deal with when considering to sell assets. On the purchaser side, though, it's much different. They would prefer asset sales because they get a full fair market value step up in tax basis, which they can use to depreciate post-closing. They can pick and choose what they want to buy or assume. They don't inherit any of the legacy exposure of the target. And then, of course, they have the price for that is dealing with the various transfer tax and administrative costs that are associated with acquiring assets, and there's certain tax elections that are generally undertaken as part of that. Contrast that to a share sale. So, as we mentioned, there is this lifetime capital gains exemption, which is a really huge sort of benefit inherent in our system that makes a share sale very attractive to a Canadian resident individual. That, coupled with the fact that capital gains are only 50% taxable in Canada. And there's certain planning that vendors in Canada generally seek to undertake to take advantage of that fact. Selling shares also allows the ability to eliminate any joint holdings or economics on the proceeds. So if we think about sort of contrasting to an asset sale, where there's a broad range of shareholders, there's always an issue potentially of, figuring out how best to get the right amount of proceeds to the right people, and depending on the holding structure, it can get a bit complicated. On an equity sale, there isn't that complication. And obviously, there's also no historic exposure that stays with the vendors. It's a clean break, and you also don't have to deal with the same transfer tax and administration costs as you would on an asset sale because everything is within the company, and so therefore everything just sort of moves over to the purchaser. Now, from a purchaser perspective, and this is something that comes up all the time, the key difference in Canada on a share sale is that you effectively inherit the historic tax balances, tax attribute balances inside the target company that you're purchasing. We don't have a 338 style internal basis step up in Canada, similar to what is often the case in the U.S. So when you buy shares in Canada of a Canadian company, you're effectively inheriting everything that was, historically in the target company. Now, having said that, there is potentially an opportunity to get a partial inside basis step up to the extent of any tax attributes that might otherwise expire in the target. And there are certain elections that can be made. And in certain limited circumstances, there may even be an opportunity for an incremental basis step up, but that requires certain planning and is very particular or dependent on the facts and circumstances. And as one would expect, when acquiring shares, you would inherit any historic exposure of the target. Generally, you wouldn't get any indemnity protection if there's a private equity or public vendor, and what we've seen is some purchasers getting insurance for reps and warranties and things of that nature. And then similarly, there would be limited transfer tax implications if acquiring shares. So important to keep that in mind because obviously acquiring assets or shares is something that needs to be done sooner rather than later on both sides of the equation, primarily when negotiating the LOI, and that's something that we often advise our clients on. So moving on to the next slide. So again, the focus of this presentation is U.S. outbound structuring. So some of the common Canadian issues that come up when we're advising U.S. entities that seek to buy a Canadian company. The importance of paid-up capital. Now, paid-up capital is, call it inside tax basis, and effectively what it is the legal stated capital of a company's shares. And the reason why paid-up capital is so valuable from a Canadian tax perspective is because paid-up capital can be used to repatriate profits equal to that paid-up capital amount free of Canadian withholding tax. So the theory is what you put in, you should be able to take out. Now, it's for this reason that paid-up capital, clients often wonder, well, how do I get paid-up capital? Can I just buy the target company shares directly? And will I get paid-up capital equal to my purchase price? And the answer to that generally is no, which is why most U.S. entities coming into Canada, we suggest for them to set up a Canadian acquisition company in order to get a full step up in paid-up capital equal to the purchase price, so that there's cross-border paid-up capital. And why that's important is obviously the distribution point that I just mentioned, but also the fact that you can generally take steps to convert some of that paid-up capital into related party debt. Now, obviously, we have thin capitalization rules in Canada, and we need to be wary of not exceeding them, and we're going to talk about that a bit in the next slide. But in effect, at a high level, our thin cap rules state that the debt equity ratio on related party debt to equity is 1.5 to 1. And to the extent that there's any interest in excess of that ratio, that excess interest is disallowed, so it's non-deductible for Canadian income tax purposes and could result in a cash tax liability. And that denied interest is also treated as a deemed dividend subject to Canadian withholding tax. So it's fairly punitive. I think the other thing that's also important to note here is the fact that in the 2021 federal budget, there, for the first time, was an introduction of this new earnings stripping concept, similar to what I guess is in place in other jurisdictions and similar to the OECD regime, whereby there's going to be, if these rules are passed as currently constituted, and no draft legislation has been released yet, but effectively what will happen is there will be a limitation, an additional limitation on net interest expense to 40% of what they call tax EBITDA, which is effectively taxable income before interest, taxes, depreciation, and amortization. And that 40% rate is going to drop to 30% from 2024 onwards. Now, any denied interest won't be treated as a deemed dividend, at least under the current understanding of the rules. And again, draft legislation hasn't been released, but there is potentially an opportunity to carry back and to carry forward that denied interest, carry it back 3 years and carry it forward 20 years. The key point here, though, is that this is expected to apply in addition to the thin capitalization rules. So that's a very important point there. And granted, we haven't seen the rules yet, and there is a minority Liberal government that just got reelected, so we don't really know what form these rules are going to take. But that really restricts the traditional approach to financing Canadian acquisitions, and is something that should be very closely watched as we move forward. So just touching a bit on what we talked about briefly in respect of the thin cap rules and in general, debt pushdown. So as we said, typically a U.S. parent will generally form a Canadian acquisition company in order to obtain cross-border paid-up capital equal to the fair market value purchase price that they're paying for the target shares. And again, paid-up capital, very important. We can repatriate Canadian profits equal to paid-up capital free of Canadian withholding tax. But we can also use paid-up capital in a cross-border context to refinance or recapitalize the Canadian acquisition company with a mix of related party interest-bearing debt and equity, as long as it stays within the 1.5 to 1 debt-equity ratio under our thin cap rules. And so, as an example, if we were buying a company for $100, that means that we could invest $40 worth of equity to get paid-up capital of $40 in our Canadian acquisition company, and loan $60 of interest-bearing debt into the acquisition company, which would then turn around, buy the target company shares, amalgamate to form a combined entity, and effectively push down that interest expense on the related party debt into the combined entity, so that you'd be able to offset the expense against future post-closing profits from the Canadian business. So a debt pushdown is really something that's very standard planning in Canada, and often something that we see quite often. It doesn't always necessarily work out, and not necessarily for reasons that are Canadian related, but also there may be implications in other jurisdictions, namely the U.S., of dealing with the interest income inclusion on such related party debt. And then when you factor in the potential earnings stripping rules that may apply, that will further restrict the ability to push interest expense into Canada to offset against post-closing profits. So moving on, I think another issue that we really see all the time, this is one of the most common issues that we come across in our practice, are dealing with what we call flow-through structures, which is a very popular type of structure, often used by U.S. investors, namely private equity funds, who seek to invest in Canada and have fully flow-through treatment from a U.S. tax perspective. And the way this is generally achieved is by having a disregarded U.S. LLC, whether it's viewed as a partnership or otherwise from a U.S. perspective, but effectively that entity would then invest in a Canadian unlimited liability company, which would be treated as disregarded from a U.S. tax perspective. And Canadian unlimited liability companies are only available in certain provincial jurisdictions. We see them most commonly in British Columbia, given that there's not a requirement for a Canadian resident director to be in British Columbia, but other jurisdictions also have unlimited liability corporations. The key point here from a Canadian perspective is that regardless of the U.S. treatment of the Canada ULC as a disregarded entity, we view that entity as a corporation. So a ULC is a corporation from a Canadian perspective, and an LLC is also viewed as a corporation from a Canadian tax perspective. So if you think about, Canada ULC making payments that are subject to withholding tax, so things like dividends, interest, royalties, things of that nature, whereas those payments may not necessarily be seen or regarded from a U.S. tax perspective, the treatment would be viewed from a Canadian tax perspective as being paid by a corporation to a disregarded entity for U.S. purposes, which, although it's a corporation for Canadian purposes, may not achieve treaty benefits. And the reason why treaty benefits aren't generally available on those types of distributions is because of the anti-hybrid rule that we have in the Canada-U.S. treaty, which basically states that distributions or payments that are made between Canada and the U.S. have to have effectively the same type of treatment. in both jurisdictions. So while this may be disregarded from a U.S. perspective, in Canada, we'll view this, such payments as being made from a Canadian corporation to a U.S. corporation that isn't liable to tax in the U.S. on its own, and therefore could potentially be, will effectively be denied treaty relief, such that any such payments would be subject to 25% withholding tax. So that's not to say that there aren't other types of structures that could potentially work when dealing with Canada. I mean, we've seen Canadian regarded companies that are owned by disregarded LLCs that are owned by U.S. residents. And in those cases, you might be able to get treaty benefits. There may be cases where there's an S corporation, for example, that owns a Canadian company that you may be able to get treaty benefits on certain types of distributions in certain circumstances. But generally, when we see disregarded LLCs over disregarded ULCs, that's like the perfect storm. And effectively, treaty benefits are generally denied in such cases. And it just goes to show that, the importance of cross-border paid-up capital, in these types of cases really are paramount. And so with that, just want to end off on a final slide here. And I don't want to go into too much detail on the application of the foreign affiliate dumping rules. These are very, very complicated rules in Canada. But we see them, having an impact on what we call sandwich structures, which, from an M&A perspective, if you can think of a Canadian target that, is Canadian owned and does a lot of work in the U.S., and so they set up a U.S. subsidiary, perhaps to have certain employees down there or have certain IP down there or whatever the reason may be. When a U.S. buyer comes in to buy that Canadian company, that purchase could potentially trigger the foreign affiliate dumping rule to the extent that the U.S. subsidiary forms more than 75% of the fair market value of the Canadian company. And if the foreign affiliate dumping rules would apply on that acquisition, then there could be two things. One, a deemed dividend paid from Canada to the U.S. parent, which would be subject to withholding tax, as well as a reduction in the paid-up capital that's cross-border between the U.S. parent and Canadaco. Now, that paid-up capital, if we assume that there's only a paid-up capital reduction, let's say there was no related party debt, can be reinstated if the U.S. subsidiary is moved out from under Canada. And so oftentimes when we see structures like this where there's a foreign sub underneath Canada that's acquired by a U.S. parent, there's a strong incentive from a Canadian tax perspective to get that foreign subsidiary out from under Canada to avoid having to deal with these rules, because these rules would apply if Canadaco, in this case, continued to fund U.S. subsidiary while being foreign controlled. And so there's generally a few methods of getting the U.S. out from under Canada in this case. We've listed a few of them here. The 881D bump is often the most common, I think, that we see, but is very complicated and may not be available in all circumstances, particularly where there's things like management rollovers and earnouts and things of that nature. A 93-1 tax election is effectively an election that converts what would otherwise be considered active business income that's earned in the U.S. subsidiary to reduce the proceeds of disposition by the Canadian company on selling the U.S. subsidiary out from under Canada. And then a 111.4E designation is actually the internal basis step-up concept that we talked about at the beginning of the presentation, which effectively treats, any accrued gains. You can make an election to trigger those accrued gains. So if there's perhaps expiring capital losses in Canadaco, you would effectively convert those losses to basis and then sell the U.S. subsidiary out from under Canada after at no gain. So certain things that need to be considered and thought through very carefully to avoid any negative tax consequences. And so with that, I'm going to pass it over to Mauricio to talk a bit about Mexico.
Thanks, Mitch. Thanks, Michael. In the Mexico part, we will be covering the M&A basic tax considerations related with financial operations in Mexico, considerations on stock and asset deals, basic considerations of in case of a Maquiladora was acquired on an M&A transaction. And finally, we are going to, let's say, wrap up this with, the highlights of the labor reform and the published tax initiative reform that it's just recently published. Starting with financial considerations in Mexico, business interest will have limits according with, let's say, two tests in Mexico, and the benefit interest will be deductible or only will be deductible under the lower of both testings. The first one is the adjusted taxable profit, that it's basically 30% of the taxable profit plus interest generated and asset depreciation of the year. Additional to that, adjusted taxable profit will have like a 20 million pesos exemption in each year. Additionally, in case of a non-deductibility of business interest in 1 year, companies or entities will have, let's say, a 10-year carry-forward option in order to take those non-deductible interest moving to another years. The second test, it's basically, and it's similar to the think-up rules that the Canadian legislation has, but instead of 1.5 to 1, in Mexico we have 3 to 1 debt equity rating, and basically, as I mentioned before, the excess of those ratios or the adjustable tax profit amount, those interests are going to be subject to non-deductibility on the year. The difference between both is that think-up rules are a permanent non-deductible interest, so think-up rules does not allow carry forward for next years. For this, another consideration to have in mind when financing operations in Mexico is that with all the support documentation or intercompany loans basically need to be under arm's length principles and need to be well supported with a transfer pricing study. Additional considerations on financial operations in Mexico, it's basically that Mexican legislations have inflationary effect, and having those types of liabilities used for financing operations in Mexico will have a taxable impact on an annual basis. Just as a matter of illustrative thing, general interest rates in Mexico go from 4.9 to 21%, depending on the parties involved and their financing that is getting to the Mexican entity. Additionally, it is important to bear in mind that tax reliefs could be applied if both entities or the entities are able to apply for a double tax treaty. In some cases, the reduced rate could be 10%, normally used with U.S. and Canada double tax treaties. Moving to, let's say, considerations on the stock and asset deal, it is important that, let's say that in a stock purchase deal, it is important to identify or have present that normally family-owned entities in Mexico with no corporate governance that could trigger considerable taxable exposures. Other often issues that could arise could be the lack of substance or support documentation and on intercompany charges. That tax exposures could be generated, considering that Mexican legislation at this point it's looking for at all times business reasons, support documentation, and basically substance in all the transactions. So any lack of those elements will be generating, let's say, tax exposures on any M&A transaction. Another additional consideration that we always need to have in mind is that in transactions of stock deals, both parties involved in the transaction. If both parties involved in the transaction need to be, let's say that, as Michael mentioned, all the contingencies of the entity will inheritance, and being in a transaction like the M&A will be the buyer and the seller will be always liable responsible. And finally, and one thing that it's a little bit different from foreign legislation is that Mexican legislation have a general rule that all entities must maintain at least 2 separate shareholders at all times. So this is a particular consideration that needs to be considered. Moving to the stock deal. Normally, in a stock deal, it's necessary to consider at least to review legal ownership of the proposed assets, invoices, and that comply with the full description of the asset, pedimentos in case of imported assets, and in some cases you need to go further let's say leasing agreements in which the seller acquires those type of assets. Additional, it is important that mention that for Mexican tax purposes, intangible assets will be, let's say, that the intangible assets are not as straightforward as it could be, and under Mexican legislation, to be able to deduct those intangible assets, you need to comply with certain circumstances and requirements to be able to have that deduction or depreciation in place. Moving to the considerations of the Maquiladora regime. When a Maquiladora regime is involved in an M&A transaction, we think that important things to need to be considered are, let's say that basically, and I think the important one is that maquiladoras are not allowed to perform domestic sales. So with that, maquiladoras is let's say, limited regime in Mexico, and it's just to work under instructions of the foreign entity. Another of the limitants that the maquiladora has is that at least 30% of the machinery and equipment need to be property of the foreign related parties. For a maquiladora regime, no intercompany charge are allowed, considering that basically maquiladoras are a cost-plus entities in Mexico. With that said, it is complicated to, let's say, to foresee that some intercompany charge like royalties or administrative service can push down to the Mexican maquiladora. Another important thing in the maquiladora regime is that basically maquiladora regime, it's a complex regime to be in compliance. And in order to be in compliance with, if one of the before mentioned conditions, among others, are unfulfilled, considerable tax consequence might arise, like, let's say, permanent establishment for the foreign related party, temporary imports as machinery and inventory must be returned abroad, or you may change the regime of those products and assets. And with that, a lot of duties and taxes will be triggered. That's why it is important to bear in mind that let's say that the maquiladoras are not just let's say like an election like in the U.S. and maquiladoras it is let's say, a complicated or complex regime to be in compliance. Additionally, when an acquisition of a Maquiladora in an M&A transaction, it is important that any type of modification that IMEX Maquiladora program or any other IMEX program, if the buyer is thinking in change some of those type of programs, it is important that they need to know that those changes could take considerable time and expenses for the transactions. And just as a reference, in normal terms, Maquiladoras in Mexico determine their tax base under two different options: a safe harbor computation that it's basically 6.5% on cost or 6.9% on assets. The second option is the advance price agreement, and that advance price agreement needs to be celebrated with the Mexican tax authorities. And finally, we will, in this slide, we will highlight, let's say, that labor reform, and we will highlight special facts of the 2020 initiative reform. For labor reform considerations are basically that subcontracting personnel is not longer allowed. Fees for subcontracting personnel that perform activities and is not registered before the Labor Ministry will be a non-deductible expense for tax purposes. Normally in Mexico, a common structure that in Mexico had in the past was that normally companies had a second payroll entity. That second payroll entity is not longer allowed since this 2021 labor reform. Moving to the 2022 initiative reforms. We can see that principle in this reform, the legislators in Mexico are including principal aspects that are strongly related with business reasons, economical systems, and support documentation. As we mentioned before, any lack of these factors will disallow any possible tax benefits or tax exceptions stated in Mexican legislation, and in some cases, deductions will be disallowed too. For a Maquiladora regime, this reform have a new disposition that in it that the advance price agreements could be no longer allowed for determining the tax base determination. So basically, if this tax reform set in force in the next month, Maquiladora will be able to let's say compute the tax determination under the safe harbor as we mentioned. And finally, for big entities in Mexico, a statutory audit report will be mandatory again, and it will be mandatory for entities that report revenues on last year higher than 1.6 billion pesos. With this, I will turn back to with Mitch.
Thank you, Mauricio, and thank you, Michael Joseph. Really appreciate the presentation, appreciate everyone listening to our update with respect to what's happening in the U.S., Canada, and Mexico. As you can see, the environment is somewhat complex. We're dealing with also potential and also enacted tax changes. So I hope that you found this session useful. Want to also make you aware that we are going to be having some other sessions coming up that are featuring other members of our virtual M&A Hub. On January 27th, we'll be covering M&A across Europe with Frederick Boss, who is a member of our virtual hub from the Netherlands, and Chris Knipp, who runs our European M&A practice. On March 29th, we will cover Asia Pac with Eric Chen, who is our Asia Pac member, leader for M&A, and Dorothy Yang from Hong Kong, who's a current member of our hub as well. And then we will finish on May 25th with a focus on U.S. and U.K. deal structuring. So I hope that many of you that joined this webinar will join us for future webinars where we cover M&A issues and cover them from a regional perspective.